Revaluation model. When one entity follows revaluation model, there will be 6 treatments. Take this example. Cost of an asset is 25,000. Life is 10 years, so every year we will be charging 2,500 as depreciation because depreciation method is straight line. Gross block is 25,000 at the beginning, cost at acquisition. Position at the end of 4th year is carrying amount 15,000 because gross block 25,000, depreciation 2,500 charged for 4 years 10,000. So carrying amount at the end of year 4 is 15,000. Asset revalued at 21,000. There will be 6 effects for this. 51,000 carrying amount is 21,000. So what is the increase in the value of asset? Cost of the assets increased by 6,000 rupees. 15,000 becomes 21. Okay? So, increase in the asset, PPE debit, how much? 6,000. 21 minus 15,000. What are the credits? See the second one. Revaluation surplus, how much? 6,000. Revalued upwards by 6,000. But this gain should be recorded net of tax. You see income tax rate is 30%. So you see deferred tax liability created 30% of 6,000, 1,800. So what is the entry for all these 3? PP debit, revaluation surplus and deferred tax liability. That is 4,200 and 1,800. This is 30% and this is 70%. PP debit in the balance sheet, revaluation surplus net of tax. It will be appearing first of all in OCI. Thereafter, it will find a place in the balance sheet other components of equity, and deferred tax liability will find in non-current liability. So these first 3 things when one asset is revalued. Increase of the asset by the amount revalued, revaluation surplus credit net of income tax, and deferred tax liability is created. Now, what are the effects of this after the revaluation? See number 4, depreciation expense increases. 6,000 additional amount added will be depreciated. Remaining years is 6. That means every year depreciation expense will be increased by 1,000 rupees. What is the effect? Income tax expenses reduces by 300. As we know that expense 1,000 rupees, income tax rate 30%, my actual expense is 700. Expense 1,000, income tax rate 40%, actual expense is 600. So if I charge depreciation 100 rupees more, my actual expense is 700. So profit will be reduced by 700, not 1000, because there will be less income tax payable. Last, amount from revaluation as per retained earnings, 1000 into 70%, 700, or 1000 minus 300. When we charge depreciation is more because depreciation is charged on the revalued amount. Tax rate 30%. So my profit is reduced by not 1000, by 700. That amount is transferred from revaluation surplus to retained earnings, because at the end of his life this revaluation surplus, this will become 0. Remaining 6 years, 42,000 rupees will be 4,200 will be transferred from revaluation surplus to retained earnings. In this connection, we need to remember that from a practical viewpoint, revaluation takes place either at the beginning of the period or at the end of the period. Revaluing assets any time during the course of the reporting period will invite more trouble than solved. So revaluation generally takes place either at the beginning or at the end of the period. If the revaluation takes place at the beginning of the year, all 6 adjustments will be in that particular year. But if it is at the end of the year, first 3 adjustments will be end of the year, remaining 3 in the subsequent period.